I think the Puerto Rican problem is looming a lot larger for the U.S. than what's happening in Greece. And I think the potential for spillover is greater. But, you know, the irony of it is that Puerto Rico is actually more solvent than the United States. The only difference is the Federal Reserve is monetizing Treasury debt, but not Puerto Rican debt. You know, if we didn't have the Federal Reserve in our corner, we'd be defaulting too.
All right, hold on. You're not saying that the selling that we saw overnight was on Puerto Rico as opposed to Greece? You're not saying that, are you?
Well, it got started, I think, because of Greece. But look, we closed on the lows. The Dow was down 350 points. Percentage-wise, the NASDAQ down 122. But I think the people that are actually thinking about what's going on, I mean, if Puerto Rico is going to default on a significant percentage of its municipal debt, you know, a lot of Americans own these bonds. They're in a lot of funds. There are a lot of other cities in the United States that are also in trouble. People might begin to start pricing in risk into the muni bond market, and that could be a concern. Maybe they'll start pricing in some risk into the Treasury market because it may not be default risk, but there is a lot of currency risk. You know, I've always said that if Greece were to leave the Eurozone, it would be a positive for the euro. And in fact, the action that we had in the currency markets with the big reversal in the euro kind of supports my position here, because now that a Grexit has become more probable, we're getting strength in the euro and not weakness. And that could portend a lot of downside risk for the U.S. dollar, which means people holding a lot of treasuries around the world see some real currency risk.
Peter, look, overnight on CNBC, we had Jim Cramer talking about the fact that people out there are too complacent. When you're talking about, you don't seem too concerned about the contagion effect from Europe, from the situation in Greece. However, one of Jim Cramer's points was that you only need to look at the price action on the US markets overnight to see that the contagion from the situation in Greece, even if it's just sentiment-based, is not going to be contained just to Greece itself, or even, in fact, just to Europe. It is something that's going to impact the bigger markets around the world. It is going to impact the States, and you should be trading accordingly. What would you say to that?
Well, I think the way it impacts the States is that people recognize that there's not much difference between the United States and Greece. I mean, the problem is countries have borrowed too much money, and the United States is the leader of that club. You know, one of the reasons that Greece was able to borrow so much was because for a while interest rates were artificially low in Greece because people perceived lending to Greece is the way they lend to Germany. It was all one currency, and so people didn't perceive the risk. You know, the same thing happened in Puerto Rico. Puerto Rico had very low interest rates because of the tax-free nature of their debt in the United States and the fact that so many funds needed higher yield because yields were so low, so they were dying for Puerto Rican debt. And so the Puerto Rican politicians, like the Greek politicians, were eager to promise something for nothing. But politicians all around the world have promised something for nothing, particularly here in the United States. And that's the real contagion about Greece, is that it's a wake-up call because lots of countries took on too much debt, and they're not going to pay it back either.
Yeah. So, Peter, what do you do? What's the trade here? You believe there's more downside coming from the U.S. markets. How do you protect yourself?
Well, I think, look, ultimately the downside is going to be muted by the Fed. First of all, the events in Greece, maybe even Puerto Rico, who knows, could be the excuse the Fed's been waiting for in order to not raise interest rates and ultimately launch QE4. But I think more people might start, you know, backing up the date by which they think the Fed will raise rates, and that will ultimately support the market, as will QE4. But I don't know that it's going to cause the market to make a huge run up. I just think it might stop it from crashing, which is what should happen. The U.S. stock market is a gigantic bubble, but I think the Fed is determined to keep reflating it with air. But what people need to do is look at the real opportunities in the equity markets outside the United States, particularly when the U.S. dollar turns and money flees U.S. Treasuries back into the emerging markets, back into commodities. There are a lot of markets that are going to benefit from the deflation of the dollar bubble.
You're not going to tell me China, are you?
Money's already fleeing by the looks of things.
Well, look, you know I'm a long-term bull on China. You know, the biggest problem with China is their monetary policy because they're trying to prop up the U.S. dollar. But long term, you need to be in China. You need to be buying into the market as it comes off. Remember, everybody's talking about the big drop in China. Well, look at where we rallied before we dropped. So we haven't given back the entire rally.